Right now, AiRWA Inc. is trading at $1.10 per share, pulling back 4.74%, or about 5.5 cents on the day. Most people glancing at this on their Robinhood app or SoFi Invest platform will just see another volatile microcap stock getting knocked around. They see the red, they see the sub-$2 price, and they either dismiss it as junk or see a cheap entry. They assume the 4.74% drop means the company did something wrong today or that the story is negative. But what they are almost certainly missing isn't what is happening, but how it's happening. The why behind this 4.74% drop is far more revealing than the drop itself. We aren't looking at massive, high-volume institutional dumping on a bad earnings report. We are looking at the mechanics of an illiquid market. This move is likely happening on very thin volume, where a few thousand shares being sold can trigger stop losses or scare other retail holders. The expectation is that price movement reflects fundamental news. The reality for a stock like AiRWA is that price movement often just reflects a lack of buyers at a specific moment. The general belief, the common expectation surrounding a stock like AiRWA Inc. is straightforward. It's a lottery ticket. It's a sub-$5 stock, likely involved in some speculative high-growth potential technology, in this case, advanced air and water purification systems. Investors, particularly those new to online investing, look at this and see a ground floor opportunity. They see the green tech angle. They see the low share price, and they think this could be the next Tesla stock before it took off. The expectation is that you use your Fidelity brokerage account or your SoFi app to buy 5,000 shares, you sit back, and you hope that in 3 years a major contract is announced and your small investment turns into a life-changing sum. That's the dream that's being sold. But the reality of trading this name, especially if you're trying to do it seriously on a platform like Interactive Brokers, is a completely different world. This isn't a buy-and-hold fantasy at this moment. It's a battlefield of liquidity and psychology. The 4.74% drop today isn't because their filtration technology was suddenly disproven. It's almost certainly because the bid-ask spread on this stock is wide enough to drive a truck through. For a stock like Apple stock or Nvidia stock, millions of shares trade every minute and the spread is a penny. For AiRWA, the spread between the highest buyer, bid, and the lowest seller, ask, might be 3 or 4 cents. A single seller getting impatient and offloading 20,000 shares, which might be a trivial amount for a large cap stock, can instantly clear out the top bids and cause this exact kind of percentage drop. The reality is that AiRWA's stock movement is currently dictated by the cash flow needs of its few patient or impatient holders, not by a daily reassessment of its fundamental business value. This is a critical distinction for anyone engaged in self-investing. Let's look closer at the intraday action on this $1.10 price. It's precarious. We probably saw it test $1.15 or $1.16 earlier this morning, likely on some thin opening volume, and it was promptly rejected. That rejection wasn't a broad market sell-off. It was a specific resistance point. Why? Because traders who were sharp enough to buy the dip yesterday near $1.08 are taking quick 5 to 7% profits. This isn't long-term value investment. This is scalping. This is quick flip trading. When you're managing your own portfolio, perhaps using something like Schwab Intelligent Portfolios or Fidelity Mutual Funds for your core stables holdings, you have to mentally compartmentalize. Those assets are different. A speculative play like AiRWA held in that same individual brokerage account is an active, high-alert position. It demands attention because it moves on air. The volume today is, as we suspected, exceptionally thin. We're probably looking at less than 100,000 shares trading hands all day. This confirms that the 4.74% drop is happening in a vacuum. It's illiquid. This is one of the most important lessons in online investment. Low volume equals high volatility. It means your market order to buy 5,000 shares, which you place on the Robinhood app thinking you'll get $1.10, might not execute at $1.10 at all. It might fill at $1.10, $1.11, and all the way up to $1.14, simply because there aren't enough sellers stacked up at that $1.10 mark. Your average cost is now $1.12, not $1.10. Conversely, a market sell order to get out in a panic could crater the price down to $1.05 as it eats through the weak bids. This is why professional traders use platforms like Interactive Brokers or the advanced settings on the Fidelity trading platform. They use limit orders to specify the exact price they are willing to accept. For anyone new to this, it's a harsh lesson in market mechanics. Now, let's layer in the macroeconomic environment, because no stock, not even a microcap like AiRWA, trades in total isolation. The Federal Reserve is still indicating that rates will remain elevated for a while. When interest rates are high, speculative technology companies that burn cash, which AiRWA almost certainly is, get absolutely hammered. The expectation is that their tech is cool. The reality is that their future potential profits, even if they're huge, are discounted back to today's value at a much higher rate, making the company fundamentally worth less right now. But there's a more practical, brutal reality. Financing dries up. A company like AiRWA, which needs capital for R&D and operations, can't just go to a bank and get a cheap loan. They will eventually have to raise funds by issuing more shares. This is called a secondary offering, and it dilutes the ownership of current shareholders. That's the constant nagging fear. The fear of dilution is a dark cloud hanging over this stock, putting a ceiling on its price far more effectively than today's 4.74% move. This isn't a problem for Apple stock or Nvidia stock, which are gushing billions in free cash flow. For AiRWA, it is an existential survival problem. We saw this exact pattern play out just last week. The stock was drifting listlessly around $1.20, then bled down to $1.05 over 2 days. Then on Tuesday, it suddenly spiked 15% to $1.15 in the span of an hour. What caused that spike? It wasn't an earnings report. It wasn't a new multi-million-dollar contract. It was a single press release about a new patent application for a novel filtration membrane. A patent application, not an approval, not a commercial product. The market narrative, expectation, was, this is it. This is the new technology. The reality was that the press release was just enough to trigger algorithms scanning for keywords, which in turn caused a short-term buying panic from retail traders using platforms like SoFi Invest and Robinhood. The spike lasted less than 2 trading sessions before it completely bled out. Today's drop to $1.10 is just a continuation of that bleed. People who chased the PR news at $1.15 are now underwater and selling at $1.10 just to get out, cutting their losses. This is where good investment help becomes so important, and I don't just mean a robo-advisor like Schwab Intelligent Portfolios, which is designed for broad, diversified investing sites. I mean understanding what you own. Many investing sites will just show you the $1.10 price and the 4.74% drop. They don't show you the level 2 order book. They don't show you the spread, the volume, or the context. When you decide to invest online, especially in an individual brokerage account, you are the portfolio manager. Fidelity Investments offers a great deal of research, but for a stop this small, that research is often limited to just press releases and SEC filings. You have to go read those filings yourself. You have to understand that this stock isn't trading based on its PE ratio. It doesn't have one. It's trading on rumor, liquidity, and sentiment. So, what does AiRWA Inc. actually do? The expectation is that they are building world-changing green tech. The reality is, they are an early-stage development company. They design and, more importantly, try to commercialize advanced purification systems. Think membranes for desalination or highly efficient air scrubbers for industrial or medical use. Their business model at this stage isn't based on current sales. It's based on raising capital, spending that capital on research and development, protecting their intellectual property, and hoping to land a major licensing deal or a large-scale municipal contract that validates the technology. They are not profitable. They likely have minimal, if any, significant revenue. This isn't a critique. It's the standard operating procedure for a pre-commercial high-tech firm. But it means the stock price is totally detached from traditional metrics. The stock is a barometer of belief in their potential technology, not their current business performance. This high-risk, high-reward profile is what defines stocks like AiRWA. It's a binary bet. This brings me to a question for everyone watching. Comment below what percentage of your total portfolio you dedicate to speculative, pre-revenue stocks like this one. Are you 1%, 5%, or are you swinging for the fences with 20%? I'm curious to see what the risk appetite is out there. Looking forward, what changes this story? What takes AiRWA Inc. from a $1.10 stock to a $10 stock or a $0.10 stock? The expectation